So it's that time of year. Holidays are upon us and the countdown to the year end is getting shorter. What's left on our lists? Well, how about 3 ways to save on taxes, 1 way to increase the return on your cash, and then finally, 1 cautionary tale as a reminder as we think about investing in 2023. First, let's look at 3 ways to save on taxes, especially capital gains this year and in future years. Markets have been recovering a bit here in the fourth quarter, but over the last 12 months as a whole, they've been down, as we can see on this chart. When markets move down, most of the time our investments move down with them. It provides an opportunity to do something called tax loss harvesting. Now, tax loss harvesting can be a helpful way to realize losses for tax benefits. By selling a security at a price below what you bought it for, you can usually use that loss on your tax return now or in future years. If we look at the chart here, what you'll see are 2 different securities, one from Vanguard, it's an intermediate term municipal bond fund, VWIUX, and then SPY is an ETF that tracks the S&P 500. In both cases, you can see that over the last 12 months, these securities have moved down in price, basically with the market. And if an investor had invested $100,000 12 months ago, you can see that they would have losses around $8,600 in the bond fund, maybe $15,000 in the stock fund. If the investor sold those securities, in other words, harvesting the losses, you can see the potential capital gains tax benefits as well as potential ordinary income tax benefits from that sale. One caveat here is when investors do tax loss harvesting, it's important, and we recommend that you buy a similar security at the same time that you're selling the one that you're going to harvest the losses from, so that if markets go up unexpectedly, you're not holding cash when the stock market recovers quickly. A little bit of what we've seen here in the fourth quarter. Second tax strategy would be to consider moving taxable investments out of mutual funds and into something called an exchange traded fund or an ETF. An article in the Wall Street Journal recently estimated that about 350 mutual funds are going to pay out more than 10% of their asset values this year in capital gains distributions. And this is true even as many of them show double-digit declines or losses in value. See, mutual funds, they have to track every purchase and sale similar to any other taxable investor, and then they have to pay those gains out, the net gains out to investors at the end of the year in the form of a dividend. So as an investor in a fund, the fund that you hold may be down in absolute terms in terms of value through the year, but you could still receive a capital gains dividend, a taxable event at the end of the year. That's kind of a bad tax surprise, a little bit of salt in the wounds, if you will. One of the things that has happened recently is a number of fund companies, including Dimensional Fund Advisors and Vanguard, they've developed exchange-traded funds that look and behave very similarly in terms of total return to their mutual funds. But because of some special rules that apply only to ETFs, they can avoid capital gains tax distributions at the end of the year. Something called an in-kind creation and redemption transaction, which is very unique to ETFs. They tend to minimize or eliminate capital gains distributions, as you can see in that second bullet. So much so that in this year, when certain funds are going to be having positive capital gains distributions at the end of the year, those same fund formats in an ETF are distributing 0. So something to look at in the future would be to move those investments, particularly in your taxable accounts from mutual funds to ETFs. Now, a third way to decrease capital gains tax bills is if you're going to be doing any year-end charitable giving, you can give away appreciated securities rather than simply writing a check. A charity as a nonprofit can sell your appreciated securities without any capital gains taxes becoming due. If you sold the same security, you'd have to pay the tax on the gain. You can see in this example, which is the hypothetical example of an investor who maybe has an appreciated security, they could gift that thing away and avoid paying the capital gains tax because they're gifting the security to a charitable entity. So the $10,000 capital gains tax they would have paid is not being paid because the charitable entity doesn't have to pay it. And as well, that investor gets to deduct the full value of the gift, in this case, $51,000, creating a very large tax deduction. You can see that this is a very tax smart way to do charitable giving if you're doing some charitable giving throughout the year. And you should contact your advisor to understand how to gift securities either directly to a charity or to a donor advised fund, which would have the same result and allow you to fund charitable interests throughout the year. Okay, as we all know, the Fed has been raising their target interest rate and many other rates have followed along through the year, but not all of them. For investors holding larger cash balances, the range of rates paid on cash can vary a lot. Just 1 year ago, there wasn't enough interest payment out there to warrant being that choosy about our cash vehicles. but not so today. Looking at the rates on this, you should know, maybe it would do me some good to pay attention to where I'm investing my cash. In the Wall Street Journal last Friday, the national average for savings account rates was still 0.19%. So the biggest money center banks are still paying savers very little for holding savings accounts. Same time, the national average money market annual yield was 0.32%. Now look below at the money market rates available at Charles Schwab. And these rates, while they're unique to Schwab here, other brokerage firms and purchase money markets are paying similar yields on money market funds. You can see that it really pays investors right now to think about where it is they're holding their cash. The Schwab Value Advantage Money Fund investor is paying 3.78%. Now, one thing to recognize is these money market funds are not FDIC insured with bank deposits may be, but the interest rate differential on a daily priced money market fund is pretty incredible. If FDIC insurance is important to you in holding cash, you can see some online vendors like Flourish Cash, where they provide an FDIC account that's yielding right now 3.75% on the first $250,000 of deposit. The idea here is there are some higher rates available for cash today, significantly higher rates than were available even 12 months ago. And it makes a lot of sense for investors to pay attention to where they're holding their cash. We haven't seen rates like these since 2007. Finally, a cautionary tale. Boring can be beautiful for the long-term investor, but you don't need to look very far to see a couple of this year's examples of exciting stuff that didn't work. I do like this quote by Ben Carlson. When the boring stuff doesn't work, it might mean you have a little bit of underperformance. But when the exciting stuff doesn't work, you can lose all your money. It can go to zero. Every year there are cautionary tales for investors to learn from. 2022 was no different. One example is the trial and conviction of Elizabeth Holmes involving the Theranos fraud, which you can read about, by the way, in the excellent book, Bad Blood. If you're looking for a Christmas gift recommendation, I would highly recommend this book. Very recently, the mind-boggling crypto unraveling of Sam Bankman-Fried and FTX is another example of these kinds of stories that seem so good, almost too good to be true, and they turn out to be too good to be true. The amazing thing to me is the number of otherwise highly competent and intelligent people who fall into these traps. Venture capitalists, seasoned investors, politicians, celebrities, athletes, no one is immune. The appeal, the story is so compelling and desirable that the due diligence and caution that should have been taken is slowly and then finally thoroughly discarded. We want the home run idea to be true. It's so exciting. It's so exciting until it goes to zero. 2023 will most likely present other opportunities for us to fall for the too good to be true story of the next investment big thing. My encouragement to investors is don't compare your actual real life portfolio to hypothetical what if this works investment stories. Instead, remind yourself that progress toward your goals is the most important metric you can have. Learn to love progress, growing your portfolio little by little, which is what can make your investment story the best story. Finally, a word about all those predictions being offered for 2023. The ones that say it's going to be a great year for stocks, or it's going to be a very deep recession, or inflation is going down or up, or the Fed will lower or raise rates some more. These are all actual predictions being offered for 2023 right now by very reputable economists and market experts. The mystery is how intelligent people can come to very different conclusions looking at the same data. Well, it's because predicting the future is hard, if not impossible. As always, we think the best response is to be prepared for a wide range of possible events by being diversified, staying invested, and really choosing long-term optimism in what are sure to be some short-term surprises. So thanks for watching Financial Perspectives in 2022. This is the last planned episode of the year. So from Blake, Kate, Alex, and me, we wish you and yours a very Merry Christmas and a happy holiday season, and we hope to see you next year.